Welcome everybody to the first installment of Rochford and Associates presents 5-minute financial lessons. Some will be a little bit longer, some will be a little bit shorter, but we're going to try and keep it condensed. Much like yourselves, we know how dry and boring some of this material can be, but it's really important for your financial future to understand some of these principles. So we're going to try to make it as condensed so you get the basics and you can know enough to be dangerous. So today we're going to talk about retirement tax codes. So your 401k, your 403b, your 457, your traditional IRA, and your Roth IRA. This is all a bunch of gibberish, a bunch of numbers and letters. I know you've heard this all before, but what exactly does it mean and how does it work? Well, what all these are all just tax codes, and they're tax codes meant for retirement. I want to preface that all of these, your 401k, your 403b, your traditional IRA, your Roth IRA, in and of themselves, they're not investments. It's just a tax code. Inside these tax codes, you can have multiple types of different investments. You can have real estate, you can have stocks and bonds, you can have annuities, you can have ETFs, you can have precious metals. These are just tax codes, not investments. So what do these tax codes do? Well, these tax codes are meant for retirement. What that means is it allows you to grow your investments tax deferred until you're of retirement age. Now, just because it's tax deferred doesn't mean that it's tax free. You're either going to be paying your taxes up front or you're going to pay your taxes on the back end when you go to take distributions. Your pre-tax money, your 401k, your 403b, your 457, and your traditional IRA, this is all pre-tax money. That means you pay taxes on your distributions on the back end when you take them in retirement. Your post-tax money, that's your Roth IRA. That's money you received in your paycheck, it made it to your bank account, and you use that to purchase an investment through a Roth IRA. That money is going to grow tax deferred and will come out tax free in retirement because you paid your taxes once and you paid them up front. So these are the basics. I'm going to give you an example of how this all works together so you can see what I mean and that they're just tax codes. So in this example, I'm going to purchase a 3-year CD paying 2% annual. Now, the CD itself is the investment, but like I said, you can have investments in different tax codes. To show you how these tax codes work, I'm going to do one with post-tax money, one with pre-tax money, and then another one which is non-qualified. What non-qualified is it just means that it's not a retirement tax code. So you will be paying taxes every year on that. So in this example, I'm going to buy a 3-year CD paying 2%. I'm going to spend $1,000 on each CD. Some assumptions. I'm age 65. I'm still working. I clarify that I'm still working because to fund a Roth IRA, it has to be with earned income. So in order to fund or to purchase a CD through a Roth IRA, I need to have earned income. To make things easy, we'll say there's a 20% annual tax that I'm paying, and we'll get into it. So, what's my interest rate? Well, the CD itself is offering 2%, so it doesn't matter what tax code it is. That's what the CD rate is. Now, the difference is, what are you actually going to be receiving of that 2%? Well, with your Roth IRA and your traditional IRA, you're going to receive the full 2% because it's tax deferred inside of those accounts. With your non-qualified, you have to pay taxes every year. So assuming the 20% tax, you're only actually making 1.6%, and that's what you're going to be compounding in the future. Now, after 3 years, what's the value of the CD that you invested? So you put in $1,000. What is the CD value? Well, the CD value for the Roth and traditional is the exact same, $1061. It's the exact same investment. It grew at the same rate. It's going to be the same value. Your non-qualified is going to be slightly smaller. Like we said before, you're compounding a smaller interest rate because you have to pay taxes each year. Now, say now you're 68. You want to cash all of these out at the end of the 3 years and you want to go on vacation. Well, you see what the CD value is, but how much do you actually take home from that? Well, your Roth IRA is the exact same because you pay taxes once up front, grew tax deferred. So now you get to take out your distributions cash or tax-free. I'm sorry. Now, same for the non-qualified. You paid your taxes annually, so by the time the end of the 3 years you paid your taxes, you get the value of the CD. Now, the biggest difference that you're going to notice, and this is what surprised people most, is with your pre-tax money, you've never paid taxes on it. So now in retirement, when you take your distributions, now is when you would pay taxes. So the 1061 of the traditional IRA now becomes 849, assuming a 20% tax. So this is very much the basics. There's some other rules and other things you need to know about Roth IRAs and traditional IRAs and non-qualified accounts, but just so you have a little background of the absolute basics, I hope this illustration helped.